everybody. Thanks a lot for joining me on this Monday afternoon market recap. This is the chart on my screen right now of the S&P 500. A very positive session today as at the close on Monday. The markets were up, on average, around 7%, a big daily move to the upside. It is very similar to other past candlesticks that we have also obviously produced, especially towards the back end of March. There is no doubt in my mind that we are essentially trading in some form of a channel at this particular point, not only on the S&P 500, but also more importantly on the Dow Jones and the NASDAQ. What makes this even more intriguing and has me a little bit cautious, you could say, about this bullish bounce is that even as most recently back, as this candlestick over here on Tuesday the 31st, and then of course the first trading session in the month of April, which was, the first being Wednesday, we began to set up that of a reversal gap to the downside. And it made a lot of sense given, of course, the texture that we still have this open window down here. And this takes us all the way back to almost the midpoint of March. This candlestick here is dated the 23rd. So now again, if we rewind or fast forward to today's session, we have a positive gap, It's pretty much a gap and go whereby we gapped up to begin the session. And essentially we never looked back. We got a little bit of a pullback on a 5-minute chart. And then of course we were off to the races all the way through to more or less the final 5-minute candle on the closing print for Monday alone. Now what makes me a little bit, as I alluded to a little bit earlier, a little bit sort of cautious about this is the simple fact that we've spoken about a potential bounce playing out. This bounce has taken me a little bit by surprise. But when you start looking at, again, the oscillators on the weekly time frame, which still haven't actually rounded out and made their definitive bottom, and just thinking about this snapback rally, which is now pushing into its third week, Very marginally, of course, after consideration of this intermediate wave, When you think about this also on the daily time frame, whereby, again, if you wanted to mark the 23rd as the low on the daily, oscillation, especially on the stochastics and the MACD, you can see that as we are pushing back on up, roughly to say 2,700 as a rough vicinity, you're already starting to see that stochastics move back up into overbought territory. And we were really just talking about over the weekend the symmetry, of the daily time frame working in conjunction with the weekly time frame as well, and really wanting to see both of these oscillators not necessarily or not up in overbought territory, but more so the symmetry of both of these fractals coming back down into oversold territory, marking that of a double bottom, so to speak, even if it does temporarily overshoot, of course, the candlestick on the 23rd, but more definitively closing the chapter of this current story, the story being that of the first wave of the downside sell-off, before, of course, we can really get behind the sort of the platform or the foundation upon which we are already starting to see these markets bounce off from. Now, again, just to warn you, because we have seen the markets up 7% on Monday's session, it really doesn't change our analysis whatsoever. Let me just remind you of a couple of past types of scenarios that we have walked into in the world of trading more recently. One particular instance was on this particular candlestick over here. It was the 9th of March. We had a very bearish session. What happened the following day? We closed up, or at least we gapped up. We traded down into a session, but we closed above the previous day. And again, in consideration, or in context of the candlesticks that we have seen, these daily prints here are prints larger than 6%. So, these are really significant movements that I'm talking about back in the mid part of March. Anyway, on Tuesday the 10th, we reverse that of Monday's move. However, rewind or fast forward again to Wednesday's session, we saw the complete collapse of that, and it just set off, again, the finale, or what has been that finale, through to the bottom on the 23rd. Again, very similarly, we got the gap down. This is leading into Thursday. Friday, we closed very positive. I think this is the session whereby we were up very close to, if not on 10%, on all of the major US market indices. However, and even that was taking into consideration the dramatic Fed action, or the action that the Fed took over the weekend, lowering rates to zero, and again saying they will do essentially everything in their power to backstop these markets. What happened on Monday? We saw a very aggressive sell-off. So I just wanted to say that seeing the markets rally up 7% in this session, it's really good. It's really positive. I'd rather be speaking about the markets closing up significantly than, of course, closing down. However, that sort of that other part of my mind that's saying, well, keeping this in, I guess, perspective and keeping things as level as what you need to at this particular point, and also considering now that we've just set up another open window right? We've got two bullish open windows, one on the 23rd, now of course one between the difference of today's session and Friday's session. And just given the context, just the general backdrop of these markets and what they're facing globally, it just makes a lot of sense that if people are up here buying this with a daily oscillation as overbought as what it's moving back up into on the daily time frame, and thinking about that weekly oscillator that still has a little bit further to move down, it makes a lot of sense that a lot of short-term buyers are going to be trapped up and around these areas if and when this market takes a very quick and dramatic turn for the worse, however ultimately stabilizes and then sets up that sort of more intermediate move or that correctional move back up into these higher areas of resistance. Nothing has changed whatsoever on the macro sort of overview of how we're looking at these markets. It is going to be a very volatile period, not only in the month of April. I mean, I understand it's been obviously a very volatile period in the month of February. That has continued more so into the month of March. I still think we are going to see continued volatility, probably all the way through to, say, June, July at an absolute minimum. So don't think for a moment that these 7% movements in the markets are going to be a thing of the past. I do believe they are going to stay. They are going to linger. And I think it's a representation of really what's happening beneath the surface on a macro time frame across the board for all three of the closely followed US market indices. Now, again, the Dow Jones Industrial Average up 1,627 points, a fantastic day's worth of session on Monday. You can see that we're actually pushing above the little swing highs over here that we pretty much produced or at least priced in 1.5 weeks ago now. The same is true for the S&P 500. So again, there seems to be a lot of positives, which is fantastic. I know this market has just been completely blindsided to some extent by a bunch of negatives. It's great to see, right, those green shoots coming through and to actually see a little bit of constructive price action. However, I do believe, unfortunately, right, that this is going to be short-lived. And I understand it's easy to be swept up in the emotion of it, but try not to be. Now, I've referenced this and I haven't made a big deal out of it whatsoever because, again, it's not really bringing into consideration a lot of the different segments of technical analysis. However, when you're looking at just the declining exponential moving averages, at least when you pay attention to this on the Dow Jones and this S&P 500, is that we've now moved below the declining 20 exponential moving average. We've now also moved above that of the declining 10 exponential moving average. So again, these are technically, in retrospect, they will act as resistance. However, you don't necessarily need to turn down on or off from them on the dime. So again, you can see how we've pushed above it, so to speak, on the Dow Jones. Again, we've pushed above it on the S&P 500. We obviously still have that declining 50 exponential moving average. But really what's most important at this particular point, and if we don't hold at resistance here, it's a matter of inevitability that it's going to happen at the declining 50 exponential moving average. What's more important, however, are these longer term simple moving averages above price action. I've gone into great detail as to why that is, historically speaking as well, during these times of market uncertainty and given, of course, just how deep and how far into this bull market we have been. Obviously, that is concluded now, given, of course, the more recent 35% sell-off during the period of February and also March. But what is most critical right now is not really buying into or at least thinking about these 7% pops like we saw today on Monday, but more so what happens around these sideways moving, simple moving averages. That's really going to be the great reveal for these markets. These are still coming in, obviously, at varying levels on the chart that you're looking at, whether it's the NASDAQ, which seems to be a lot closer than that of the Dow Jones Industrial Average. So again, there may not even be an opportunity whereby the Dow comes back on up into its simple moving averages if this is going to be a macro top. The S&P 500, I kind of like it. It's more so the midpoint, obviously, between the Dow and the NASDAQ. But again, really what I'm trying to do is at this Monday afternoon is just to say, look, it's fantastic to see these markets up 7%. We are personally moving into the week and we're expecting these markets to come back down and to retest and to close this open window back to the 23rd and even produce some form of a whipsaw, which makes a lot of sense as well before starting off on that sort of multi-month run, which is going to be confirmed by the weekly oscillating indicators. But again, you do get these pops, right, during these very volatile periods. All right, no one knows what the market's going to do over a weekend, moving into an abbreviated week's worth of trade on a Monday. Just simply don't know. This week, however, unlike many of the more recent weeks, it's been a positive bounce, right? It's been a gap and a go. However, part of me thinks that sooner rather than later, this gap is going to be closed, and then this gap is going to be closed as well. And there's probably going to be a lot of people confused up here as to why that is, and I don't want you to be one of those people. Okay, I don't want you to be one of those people. There's no reason, right, for you to be one of those people. Okay, so that's going to do us as at this Monday afternoon market recap. Above all else, continue to be safe, be well, look after your loved ones, and I'll see you later in the week for another market address. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Farewell.